Hey, hi everyone. I'm Margot Kennedy, and this is Christy Brock, and we are wiicre. We invest in commercial real estate. Thank you for joining our webinar today.
And I'm going to go ahead and share my screen so that we can begin our presentation. Today, we're doing a case study, and this is, hey, is self-storage as a strategy a good one for you for your retirement? So let's go ahead and get started. Margot.
Did you share the screen?
Oh, I guess it would help if I did share the screen, right?
So I know where I am.
No worries. Give me 1 second. Let me do it correctly. Here we go. Share and PowerPoint. All right. All right. Now you can see my screen. I
Okay,
think
I
we're good
can
to
see your
go.
screen.
Excellent.
As Christy said, we're doing a case study today about self-storage as a great strategy for retirement income. What we're going to talk about over the next 30 minutes is how group real estate investing works, why self-storage is such a powerful strategy, and we're going to take a look inside a real self-storage deal that we acquired and still hold, and talk about how our strategy generates cash flow without landlord responsibilities. That's a win. And how to evaluate if this strategy is a good fit for your retirement goals. So as I said, I'm Margot Kennedy. I have over 36 years of a variety of real estate experience. I've been an equity partner in over $45 million worth of real estate. I'm a current and past GP on 7 commercial real estate projects, which include more than 800 units of self-storage. And my experience spans everything from property management, commercial leasing, senior housing, project coordination. I've been a controller, and I've also been a realtor licensed in Maryland since 2002. Christy?
And I have over 23 years of real estate experience. I had a small real estate and mortgage company for a number of years. I've raised a lot of money for various commercial deals. And Margot and I are partners on 2 self-storage deals, and we're in the process of acquiring a third. But we are here to educate you and talk about, how this strategy will be great for you. Our mission as a company, wiicre, we invest in commercial real estate, but what we're focused on is building passive wealth for our investor partners. And today we're focused on the last paragraph here, which is through education. This is a no pressure, just, hey, here is how this type of deal or these type of deals work. This is how wiicre, how we structure our deals. The power of group investing. So, and group investing is kind of an interesting word. Anyone who owns stock or knows that, the stock market exists, that's group investing, because no one's going to create their own Intel or Microsoft or Procter and Gamble, any of those. So what this does is it gives everyone, the average investor, access to larger deals that you wouldn't normally be able to buy for yourself. It's okay, hey, if you're buying something for $500,000 or even $1 million, but when you're buying 2, 3, 4, $6 million properties, it's better to do that with people because it takes a village to do a really good real estate investment, commercial real estate investment. By doing group investing, you have experts that are doing the heavy lifting, like us, and you get to earn passive income and long-term growth. And that's a very important point that we'll come back to later on in our presentation. As Margot said, there's no management responsibilities. We, the experts, take care of all of that, and we share the risk, we share the reward. It's commercial real estate made simple, smart, and stress-free.
Yes. So how does group real estate investing work? Well, we find properties, and to find a property, we may well look at 100 different properties before we even decide to pull the trigger on one. Once we've gotten it under contract, we begin the due diligence process, which is a very, very deep look at all of the financial reports, contracts that they have, anything that has to do with the property, surveys, appraisals, phase ones. And we also go on site and look at every single unit that we can look at. We look at all aspects of the property, the roofs, the driveways, the infrastructure, you name it. Once we've decided that this is a good deal to move forward with, we start sharing it with you, our investors, and give you an opportunity to invest. Once we've closed, we go in and make improvements to the property. And as we all know, when we increase net operating income, we increase the value of the property. So once we reach our preset threshold, we exit the property.
It's a powerful strategy.
It is. So why is self-storage such a great asset class? Well, first of all, we consider the customers in self-storage to be sticky customers. And what that means is it's kind of easy to hold on to them. No one's going to rent a truck, invite their friends, buy pizza and beer, and haul all their stuff to another facility over, say, a $5 or $6 a year increase. It's just not worth the trouble. And that's really all we need to do a year to have good returns and continue to appreciate and value. So customers tend to stay for quite a long time. There's also what we call the 3 T's: no tenants, no toilets, no termites. We love that. That is really awesome. And the returns are easy to improve. Like I said, increasing net operating income is what increases your value. And it's easy to do. All we have to do is reduce expenses by controlling them and using better management processes and increase income. And then lastly, self-storage is a very recession-resistant asset class. It's the only sector to maintain growth during the Great Recession and other recent economic downturns. And we have a slide coming up here that really illustrates that.
So let's dig in a little bit more on the recession-resistant aspect of it. As you see here on the screen, during the last 4 major recessions, self-storage has performed very well. The dark blue line is real GDP, and wow, look how it's dropped on each of these 4 points. But occupancies for self-storage have remained constant. During COVID, which was very interesting to review as a case study unto itself, occupancy was among the highest ever. So self-storage is a highly recession-resistant industry in times of turmoil, which, you never know when it's coming. So whether times are good or bad, self-storage is boring and consistent, and that's what we like about it. 11% of Americans currently use self-storage. One of us or someone has experienced the 6 Ds: death, divorce, downsizing, dislocation, disease, and disaster. All of these aspects really help to bolster the occupancy for self-storage. Disaster is a big one. Think about Florida, Texas, other places that flood. When people are displaced, a lot of companies come in, they rent self-storage units. It doesn't even have to be that serious or that big. If you have a personal flood, what do you do? That's your own personal disaster. Divorce, obviously, when you're splitting households, someone has to go into an apartment half of the time, and and they're taking some stuff, and nobody ever has space for stuff. Or even if you're downsizing, especially in a recession, when you're going from a house to an apartment, nobody thinks, you know what, let me get rid of all my stuff. People think this is temporary because Americans have the most positive attitudes, and we always think, it's going to get better, and things do get better. Life always gets better. So the 6 Ds, very important. Again, there's also a very diverse customer base. 11% of Americans use self-storage, but it's not like in apartments where you have a Class A building, multifamily, Class A, and you have Class A people and you Class B. It's everybody, including businesses, including that boat that you can't have at your house, or that RV that your local HOA won't let you store in front of your property. Americans have stuff. We love our stuff. We keep our stuff.
That's right. So we have a wiicre buy box, and it's really very simple. We look for a property with a great story that's poorly managed, not managed as well as it could be. rents below the local comps, and low-hanging fruit. And we'll talk a bit more about this when we get to our more specific comments about our deal. So Access Jackson is the deal we want to talk about. When we bought, it's located in Jackson, Mississippi. When we bought it, it had 489 non-climate controlled units for a total of almost 59,000 net rentable square feet on just about 3.5 acres. There was also a vacant retail building close to 5,000 square feet that we decided we could convert to climate control storage spaces. We purchased it for $3.7 million all in, and our projected hold time was 3 years. And we projected returns to our investors of 7 to 10% pref during the life of the investment and a 23% annualized returns when all is said and done. And this is just an overhead look at that property. As you can see on the right-hand side that's all the non-climate control storage that was already existing and in place. And on the left is the retail space, which we converted to climate control storage.
Our business plan, the wiicre business plan, is the same every time. We acquire, we improve, we manage, we exit. In order to do this, we have this formulaic way. And so we've completed our first 3 steps. We acquired it for about 3.7. We've finished almost all of our improvements. With self-storage, improvements are very fast and predictable. And so in less than 1 year, we finished all of our improvements. Why is it important to be fast and predictable for doing your expansions and your improvements? If you're buying a 100-unit apartment building and you're planning to renovate that entire facility, the cost of renovating unit 1 versus unit 100 is going to change because it will take you at least 3 years to do that renovation as people move out.
That's right.
We had a 489-unit self-storage facility, and we went in and we did all of our improvements. We got all of our bids up front. Our costs didn't change because the time period was so short. Most of our improvements took less than 6 months. And so it's just a lot more predictable. The stage we're in now is stage 3, which is manage and distribute funds. Our investors receive a quarterly distribution, and that started after the first 3 full months of ownership. We closed on March 1st. So that was March, April, May. June 27th, the first quarterly distribution was made. And every quarter thereafter, every 3 months thereafter, we've made our distribution and we give our investors a detailed update of what's happening with their investment. We're trying to be very good stewards and with their trust and stewards of their funds. The last step is the exit, which is planned after 3 full years of ownership. What's gone right? Well, Margot, let's both kind of chime in on this one. Operational wins. We have done incredible improvements with this property. When we took it over, there was the same manager on site for many, many years, and she was not doing a good job. She was wearing all the hats. She was doing the marketing, she was doing the leasing, she was managing the improvements, she was doing everything, customer service. And there's only so many hours in the day, and there's 7 days in every single week. There's just not enough time to do a good job. So we came in, we brought on third-party management, we improved our customer service availability hours. So instead of only having 8 or 9 hours per day, 5 days a week, or 6 days per week, we have 7 days a week, 10, 12 hours. It's just a lot more efficient. One of the biggest operational wins was there was inefficiency in collections, and we remedied the inefficiencies by no longer taking cash. It's amazing the difference that makes and how much your collections increase when you don't take cash. Also, starting in the first year, we decreased our expenses by over 30%. That is dramatic. When you can increase your income and decrease your expenses, that's your NOI that's increasing significantly. So we've done very well with this. And as Margot mentioned, we've gotten our climate control units. Those came online. And it's been a wonderful, wonderful improvement for the facility. We've got fresh paint, driveways we've refreshed, and we have some pictures in the next couple of slides that we'll show you. And, you know, we're just managing extremely, extremely carefully on this. Margot, is there anything that you want to add on that? I mean, I know I gave a lot.
Well, I think, you know, your last comment here on the slide is that a carefully analyzed pro forma is vital. And I think that is one of the things we do extremely well. We are both very number oriented. We dive deep into what's really going on, not what's just reported. And we're very conservative in our underwriting. And like I said, we may look at 100 properties before we decide there's one worth making an offer on. So that's been a really good thing for us because we haven't been caught by surprise.
Right.
by
That
much
leads
of
us that leads us to our next,
Yeah,
the
the
challenge.
challenges. Of course, there are challenges, and there always are when you are doing any kind of construction. There's so many things you can't predict. But like Christy said, one of the things that's great with self-storage is we can predict what our budget is pretty closely. You know, you always want to have a little bit of an overage built in, but um, the first thing that we encountered that was a bit of a challenge was, you know, issues with contractors, local versus national. We got bids for everything we did from both local and national contractors. And, you know, you might think the national ones would be more expensive or less expensive, but interestingly enough, both sides were kind of both all over the board. But one of the things that we encountered was that with the local contractors, they're not as big, they don't have the depth. And when something would go wrong in their personal lives or in their company, it affected us. And so our first two general contractors, sadly, had severe, serious health issues come up. And we had lost our first two general contractors because of that. So that set us back, you know, 5 weeks easily in trying to, you know, reconnoiter and get everything back online. You also zoning and permitting, you know, is always a challenge. We were working with city government here, and it's a city that's really right now trying to improve how they do things and make the city better. But, you know, as a result, we're sort of caught in some of the slowdowns of them making these changes. But, you know, that's something you'd also want to really look into before you close on a property. But, you know, just be prepared that things can change because we did have a little bit of that. And then utility coordination is always a big deal. You know, every jurisdiction, again, is a little bit different. So we had to really coordinate turning on the electric, in particular with the climate control with the electrician. And it took a lot of going back and forth and, you know, multiple trips by the utility companies. But, you know, we got it there. And, you know, time and patience really makes a difference. And we have both have enough construction experience to know to be prepared for things that can go wrong. So we were very ready to reposition and figure out how to overcome the things that came up.
I think our deep real estate background really helps both of us in this. We know that it's real estate. Things will go wrong. It's
Right.
how you handle those things and how you, you know, pivot and work things out. That's what makes the difference, and how you remain calm during while all of that is happening. And I think Margot and I, we both do a really great job of that.
Yeah, yeah.
So as I mentioned, we have some photos. These are the some of the things that we did, some of the work that we did. We'll start here on the far left. These are the driveways. As you see, there were sharp edges that were really dangerous for our customers as they were getting into their units. So we did a lot of ripping up and smoothing out. And here you see, this is kind of the finished product of that. It's much smoother, much easier to navigate. We
Safer.
laid much safer, thank you. We laid asphalt, new asphalt, and one of the biggest changes was the painting. You know, I had someone tell me, I've never seen anyone so excited about blue paint. You know, because again, we give our investors little update videos to say, hey, I know it's not a quarterly update. This is a mid-quarter update. This is what's going on. It's exciting for us. We geek out over self-storage. Here's some more pictures. This is the climate control. This is the before, where it was a basic retail building. We ripped everything out to the studs. We had a crew come in, and in less than 5 days, they did 56 units of climate control. It was an amazing, incredible journey. It was unbelievable how fast they did it. And one of the things, let me also say that one of the things that Margot and I pride ourselves on, when we're spending money, we're on site. One of us is always on site. If we're spending more than a few $1,000s, like, we have to be there to oversee it. And that's how you make sure that your jobs go right. And that's why it's really hard to do that for multifamily. Can you imagine every time you're redoing a unit, you need to be on site? But we do that.
So what's it like to be an investor with us? Well, one thing we really pride ourselves on is that we do a lot of reporting to you. You probably get sick of us. But in addition to our quarterly reports, which are very detailed, we tell you what's going on in the property while we were doing construction. We gave updates every step of the way. And in the middle of a quarter, we would often do another little webinar to talk about what was going on in the middle of the quarter with the construction. And we do little videos too, just on site while something's going on, just a little quick 5-minute and share it so that everybody knows exactly what's happening. So we try really hard to keep everybody up to date. And of course, we're always more than happy to take questions and talk to anybody and give them a personal update.
What has our Access Jackson investor experience? This little roadmap takes you through our average investor who may have invested $100,000 with us. And, Margot kind of went through this process before, but let's just talk about it again. First, they were notified of the investment. That's step one. As we're going through due diligence, they received the deal information and acquisition updates, and they made their decision. Yep, this looks like a good investment for me. Then they moved on to step 3, which is signing their investment documents. There's usually a private placement memorandum, PPM, you may hear it called. And so you sign that online, and at the same time, you wire your funds. You're in the investment, escrow closes, the deal closes, we're ready to rock and roll. We're on to step 4. For us, every quarter, and so far it's been like clockwork, every quarter you get your distribution. For this deal, Access Jackson, we had 2 asset classes, Class A and Class B. One of our asset classes paid 10% preferred return, which means that every quarter you got 2.5% of that. So that's the 2,500. And then at the end of the year, instead of getting a 1099, you get a K1. A K1 is used for reporting pass-through entity income, and that goes out in March. In our case, which was really nice, our investors, although they got positive income, they got a negative K1 because as real estate investors, you get depreciation expenses and other things that offset your actual income. But that's for another webinar. We'll talk about it later. Is this strategy a good fit for you, for your retirement goals? If you're currently retired, planning to retire, think you might want to retire one day, the most important thing you're going to need is income. And as we've gone through this presentation and explain, the way we structure deals, you enjoy passive income. The other thing that's really important when you're planning to retire, a lot of people have a stock portfolio. That's awesome. Most companies don't pay dividends. So where are you actually getting your income from? How do you get your income? If you've built up this nice 401k, what do you do once you retire? Well, this is what you do. You roll it into a self-directed IRA, and then you can invest in various projects like this, which then you don't have to touch your principal. If you invest $100,000 in this investment, for example, then you would have received your quarterly distributions. When we go to sell, you receive your principal returned, and then you will also receive a share of the equity from the sale. So you get all of the benefits of real estate investing, none of the landlord headaches. Right. Our typical holds are 3 to 5 years. So it's not like your money is tied up forever. And it's not like you're doing flipping, which has short-term capital gains issues. Here you have long-term capital gains, or if you're in an investment account, you have no capital gains. You're growing in a tax-advantaged environment. Predictable recession-resistant cash flow. We've discussed this. We saw what's happened during the last few downturns. Our minimums start at 50,000, and the way that we generally structure is the higher your investment level, the better your return, your quarterly distribution, and your long-term at the end of the day distribution. So if you're looking to diversify your portfolio, real estate is a great way to do it. Self-storage is a great way to do it.
Absolutely. Well, thank you
We,
so much for watching our webinar, and we are open for questions. I think we can take a few at the end here if there are any in the chat. But as
yep.
always, if you have any questions for us, don't hesitate to reach out and get on our calendar, and we'd be happy to have a Zoom or a phone call or whatever you need to talk about investing with us.
Okay, and we had, let's see. Oh, Bob says good presentation. Thanks.
Thanks, Bob.
If there are any questions, you can type it into the Q&A. One of the questions, so I do regularly meet with investors in person also, and I was in the Bay Area and met with a couple of our investors. And I need to turn my video off and on really quickly. We're done with the recording portion, so um, you know we can have blips now. One of the
Great.
investors asked a question that was, hey, so the question was for Access Jackson, there was a lot of, I don't want to say fraud, I don't want to say theft. What we'll say is money that disappeared. How do you counteract that kind of situation? We don't take cash. All of our income is through ACH, through electronic methods, and goes immediately into our bank account, which is also unlike multifamily. In multifamily, your property management company generally holds your money and then transfers it to you. That's not the case for self-storage. We get money deposited directly. Let's see, we have some more questions.
Yeah.
So one of the questions is, what is the average occupancy and how are long-term rental units usually held? So average occupancy for self-storage these days is in the high 80s percentage, and it can be as high as in the 90s. What we generally target is our occupancy at about 85%. And with that sort of percentage, our numbers are really good. For Access Jackson, once we get to 75%, based on where we are, because our economic occupancy far exceeds our physical occupancy, which is super cool. So occupancy, that's where it usually is.
And
how were you able to increase available leasing hours and reduce expenses? Margot, why don't you take that while I post our calendar links?
So we hired a management company that has a call center, and having the management company is less expensive than, a $50,000, $70,000 employee. In so many ways, we're not paying insurance, workers' comp, employment taxes, any of those kinds of things. But they have a call center that is open for more hours during the day, like Christy said earlier. And they also are only dealing with calls and questions and customer service type things. Whereas when you have an on-site manager, it's like Christy said, they're wearing so many hats. They're missing calls. They're missing opportunities to lease units. But the call center is there's always someone there during the hours they're open. And so, like I said, it is less expensive than actually having an employee.
And one of the other things to mention about self-storage management versus apartments and Margot and I have both owned multifamily and, been on teams with multifamily management. With our property management company, when we have our monthly meeting, there's 6 of us on the call, including Margot and I. So it's just a really great team effort. and you get your updates from each member of the team. So the person who's in charge of SEO and marketing, she gives her report. The person who's our manager of our boots on the ground, they give their report. Everyone it's a much stronger effort than other asset classes. It's extremely interesting.
Everybody's working within their area of expertise.
Right. Uh, so let's see. Thanks, Daryl. We appreciate the compliment.
Yeah, thank you.
Okay, so here's another question from Tom. What is your promote structure split with investors upon sale? So here's the way that we structure our deals. We manage to an overall targeted return for our investors. On the deal that we're doing right now, Access Mead in Spokane, we're in the process, we finished our due diligence, we're in the process of raising for it. Again, this is not a pitch, this is general information. See any investment prospectus if you have questions about this property. The way that we structure this deal, we have a Class B, for example. Our investors are going to get a 10% cash flow during the deal, and it's a 22% average annualized return. So what does that mean? That means that during the course of the deal, investors get their 10% per year. Over the 5 years, that would be 50%. But we have a 22% average annualized target. So that's 110% return over the 5-year period. They've received 50% during the investment, and on exit, we get them 60%. That's what our projection is. Investors get that before we take any money on exit. We get some cash flow along the way. And then on exit, when it's the, hey, here's a, 3 million that's distributable on exit, investors get caught up so that they're at their targeted return, and then the GP team gets paid. We feel like this is a very fair way to split money because, some GP groups or some LPs want, hey, I want to get all my money back before the GPs get anything. It's very difficult for GPs to operate in that environment because if I'm promising you a 22% or whatever the split is, a lot of the reasons GPs are having problems is they're making no money for years on end, and then they're not prioritizing the deal. And so it's just not the way that we look at deals, the way that we want to treat our investors. We put our investors first, but this is a job for us. We also, do need to make money and survive. We have our contact information, our calendars in the chat, and everyone's going to get a copy of the replay. We are very excited about educating people, and we're going to send out a survey. What else do you want to learn? We have a lot of topics that we can talk about, and if you're not clear on this, we're excited about real estate. We're excited about self-storage, and we love talking about it. So thank you guys. Thank you everyone for attending, and we'll see you next time on the next presentation.
Thanks so much. Bye.
Bye.